So with that, Steve and I will take questions. Yeah, Jeff?
John, what was the problem in the thinking of the programs that said that they were going to be more aggressive, and I guess that meant more in stocks when you were younger, and then as you age, they put you into what they considered to be less risky situations, but that whole program seemed to fall apart.
Yeah, they call that, what do they call, what's the buzzword for those mutual funds? Target date mutual funds, right? So you start off in bonds and you in stock, more heavily weighted towards stocks. Over time, you gradually move toward bonds. The concept is okay, but it's sort of a one-size-fits-all. There's a limited selection of those funds available. We like the fact that you can run your own portfolio. You can customize it to whatever your particular risk profile is. You can change it as needed because circumstances do change due to unforeseen events. If suddenly you do run into a situation where your spouse dies or something, you become a lot more risk averse. You can put it into treasuries. You don't necessarily get the best approach to rebalancing the account from time to time. So yeah, it's lost attention in the media. They don't get as much attention. We don't think we just think you get a lot more flexibility by running your own portfolio.
I got to ask this. A lot of when you're elderly, a lot of associations, my age, will give you 7%. What's your opinion of that stuff?
You're talking about maybe an annuity? What? An annuity? Are you talking about an annuity?
Some of the major reports or associations will give you, give them $100,000, you get $7,000 a month, a year.
Yeah, well, I mean, there are a lot of investment advisors. Yeah, I mean, there are a lot of traditional investment advisors who make promises like that, and they ought to be in jail, all right? Those guys who just say, I'll invest it, and I guarantee you. On the other hand, there are actual products like annuities, where you can pay $100,000, you give it up, but you're guaranteed a certain percentage rate for life, a fixed percentage rate. And of course, you're gambling that you're going to live a long time, because if you die next year, you lose everything, and the insurance company gets...
What's the chances of, with the current market, of them continue to pay off?
Well, that depends on the solvency of the underlying insurance company. Annuities are not necessarily a bad thing. We don't sell them, and we can't make any money, but some of our clients use them. And you can take an approach by investing, say, in 2 or 3 different fixed annuities with different insurance companies to protect against that risk of default. And you can also stagger it over 2 or 3 years because the rate you're going to get is going to change over time depending on the current interest rate environment. The things to avoid are these guaranteed benefit withdrawal annuities. Generally, they have a lot of bells and whistles, and they promise you a floor. You're not going to get any less than this for the next X years, but you get all the upside potential of the stock market. If that sounds too good to be true, it's because it is. The floor is never really a floor, or the upside is limited, in fact, and invariably they have all kinds of fees buried in there that you can't dig out. Yes?
A question, setting aside the supply and demand issues which are driving residential housing prices today, but considering a long-term horizon, would you expect residential housing to behave like a commodity or to be highly correlated with inflation?
You got anything to say about housing prices?
Well, normally housing prices do follow inflationary trends. Right now there is a problem with an oversupply. There's a shadow supply in the market. There's a lot overhanging that market, and there's some major shifts in terms of people's reliance on buying homes. We're seeing people renting more. They get more mobility that way, and they're not finding as much advantage in holding a home. We found in the recent experience with this housing crisis that housing is extraordinarily volatile. We just did a study on that and showed that it tends to trend, run-ups and run-downs in the housing prices, and that volatility is not something you want to base your portfolio on. And your house is part of your portfolio. If you own a home, for most people, that's the largest single part of their portfolio of assets. And to base so much of your portfolio on that one asset, which is a volatile asset, is a very dangerous thing. I think people are finally coming to grips with that. So I think the housing market's going to come back slowly, and I don't think we're going to see as high of inflation rates. Of course, there have been proposals to change things like mortgage deductions as well, which would have another impact on the market.
Yeah, the housing, Steve's absolutely right. You should consider it part of your investment portfolio. And for so many years, housing went nowhere but up, and that became the conventional wisdom. Real estate only goes up. Well, we learned otherwise, obviously. On the other hand, people do take a lot of comfort sometimes in paying off their mortgage because they know that if all else fails, they at least have a roof over their head. Right? And you can't deny that fact. But the fact is, all your assets very often, if you do that, are tied up in your home. Yeah. Yeah.
Yes. I would like to know what you think about the corporate bonds, the short-term corporate bonds. They say they mature in 1 year or 1.5 years.
Short-term.
Do they have a place in?
I didn't hear what you said. Short-term.
Short-term corporate bonds, they have a place in this kind of portfolio.
Sure. Yeah, we invest.
Maturities of about a year or so.
Yeah. Corporate bonds take on a little bit more credit risk compared with government bonds. And therefore, you get compensated for that in terms of higher returns. And there are investment-grade corporate bonds that we recommend. And in the investment guide on the back page, we recommend bond funds that include corporate bonds. And as long as you're well diversified, that's a perfectly reasonable way to invest in fixed income. And in fact, you can get a reasonably higher amount of yield by doing that. Keep in mind, the whole purpose of fixed income or bonds is to add stability to your portfolio. So it's okay to take on a little bit more risk in the form of corporate bonds, I think. But we don't want to go over the line into high-yield junk bonds, which are extremely volatile and will often experience high default rates during difficult economic times. Yes?
What do you mean by hedging?
Well, yeah, hedging simply means I want to hold some asset that gives me some relative assurance that when the CPI goes up by some percent, 4%, that the value of my portfolio will also go up by 4%. So that if I'm spending out of my investment portfolio to meet my grocery bills and to make my car payments, that I can at least keep pace with price inflation on a day-to-day basis or on a short-term basis. Okay, I make that distinction between that and what I call investing for real returns over the long run. Okay, common stocks have a very good chance over a 20-year period of outpacing price inflation. However, next year, if price inflation shoots up to 7%, there's no guarantee that bonds are going to go up by 7% by any means, okay, from year to year. So if you have a long-term time horizon and you don't have to spend that money in your portfolio, if you can really wait, it's worth investing in stocks, I think. On the other hand, if you need that money to spend, you want to go with something more like TIPS or short-term cash equivalents like Treasury bills.
You want the hedging to offset something bad. If the stocks are going to go down by 2%, you'd like this to go up by 2%. If inflation's going to go up by 2%, which is a bad thing, you want this to go up by 2%. You want it to offset the potential losses, so it sort of smooths things out for you, as opposed to being used for its own return, right?
Right.
Yes?
Steve, I had a couple of questions. On the EPI chart you had, it showed that in the winter months it seemed higher versus the summer months. Is that?
Yeah.
I know it's a 2-year chart you had, but
yeah,
what explains that?
there are a number of things that had to, if you think of the time periods and different programs, Fed policies during the time, you were driving these swings as well. So it may not be a normal every year in the fall sort of an issue. But there were policy shifts that were driving a lot of that. And the EPI is very sensitive to that. We saw this last fall, we saw oil take off, and I think that drove a lot of it. And we saw not just gasoline, but fuel oil, all oil products. So we're capturing all that, and you see that move in the index.
The second question I had is regarding the bank reserves.
Right.
Was that for global banks or North American banks?
U.S. That's in the U.S. banking system. The reserves are through the roof, and there have been issues associated with the Fed doing swaps with foreign banks in order to shore them up, and there are the reasons why they do that, but that creates another risk.
Yeah. Just, I mean, I don't know if you looked at it, but some of that could be obviously due to the historical issues with the mortgage market, other poor corporate loans out there, but also newer requirements to hold additional capital.
Well,
and I don't know if you guys looked at, because you had the required amount, but those levels are going to be changing in the future. And also looking at, as these mortgages roll off or refinance, how that's going to impact those reserve amounts, because it's hard to understand how much of those reserves are going to be released over the next few years.
there's a lot of concern about it. Certainly, the world has changed. The Fed flooded the banks with these reserves. At the same time, it began paying interest on reserves, which is very strange. Here, we're going to give you some money, and now we're going to pay you interest on it. Aren't we nice? Could I get in on this deal? I mean, they give you the money, and then they pay the interest on it. Well, then the banks have less incentive to make loans because now they're holding huge amounts of reserves, which they can collect an interest rate on without having to do anything, without having to accept any risk at all, in an environment where they've been beaten up badly for making loans that were irresponsible. So we know that they're holding more in reserve for that reason. They're also viewing reserves in a very different way because of the way they're viewing their balance sheets now. So that's absolutely true, and we're not sure how that's going to play out. The Fed has talked about a number of strategies to try to keep that money from flowing out into the street. But I think part of what caused it was not just the mortgage-backed securities issue, but it was, if you look at the growth rates of the monetary base, which is the monetary base is the reserves plus currency. And that's what gets expanded through the financial system into the money supply. So the main way that it gets expanded is banks make loans, people take that money that they've been lent, they spend it, they write a check to somebody who deposits it in their bank, who then takes that money and makes another loan and gives a check to somebody else who then spends it, and it keeps circulating through the system. Okay, so that's how money is created. So the monetary base is at the core of this whole money expansion process, and the rate at which it gets expanded into the money supply is at the heart of the matter. And that expansion rate is called the multiplier, and it's really based on bank lending. And what happened is in that financial crisis, there's a liquidity crisis. Banks are concerned about their survival, and so they pull everything back, they stop making loans, and that multiplier collapsed. Well, the Fed was looking at M2 money supply, and I've talked to people at the Fed who've told me this outright. This is what they were doing, is they were trying to keep the money supply growing at the same rate. So if you look at the graph of the money supply, M2, it just goes like that. It doesn't even have a wrinkle in it. It just keeps going. And they just increased the bank reserves at whatever rate it took to keep the money supply going at the same rate as a means of stabilizing the financial system. They said that's the way to do it. Keep the money supply going forward. That'll ensure that there's liquidity in the system and the economy will be shored up. But to do it, they had to create money, bank reserves at such record amounts that there's still this question, will they be able to somehow either find a way to hold that money in the bank or to drain it off? And they're trying both things. One of the ways they've talked about even raising reserve requirements in banks, so they would just force the banks to hold it. The problem is that not all banks hold the same amount of reserves. So some smaller banks could be hurt badly when they're suddenly not allowed to make as much loans, whereas larger banks who have even more excess reserves would have less problem. They've talked about raising the interest rate they're paying on these reserves. I can't believe they're paying it in the first place, but they're talking about raising the rate, which will make it even more attractive to banks to hold on to reserves and not make loans, while at the same time they're making pronouncements in the press about why aren't the banks making loans. It's hard to follow, you know. So there's a lot of different things going on here at once that don't all seem to add up. It's pointing in the same direction. Yeah.
Steve, you depicted a the EPI, massive increase in volatility in the last, I think it was like 10 years.
Yeah.
Did your research, if we got this far, show any evidence that maybe that was a result of the popularity or massive rise in commodity investing? Or more specifically, how easy it's become for the public to invest in commodities?
We have looked at commodities some, and certainly that's true. People are moving in. It's much easier to do. You can hold exchange-traded funds, for example, and buy and sell commodities like stocks, and the public's moving in. I think also with the fear of inflation, they're also looking for some sort of a hedge, and they move to commodities. We couldn't tie it directly to that. We know that we were able to show that some technological shifts were related to it, some tax shifts, it is a commodity-related issue, but this is oil prices and the things that have gone on in oil in recent years have been a problem. So those are the things we've been able to uncover so far, but we have an ongoing research program to look for these other connections. We're very curious to see what else we can find. Anyone else? All right. Well, we thank you for coming. We'll be around for a while afterward. If you have other questions, please feel free to talk with us. And I really do appreciate you coming out and fighting the traffic and finding a parking place. But we hope to see you again soon. Thank you.